Tax season is here. Most are not fan of paying the taxes. You make investments, you do all the hard work, and when you make profits, you have to pay taxes on them. However, not everyone pays their taxes similarly. Sometimes, rich people can skirt taxes with some loopholes. One of those loopholes that rich may exploit is called wash sales. Listen to Paul Keel, ProPublica reporter, explain how rich exploit the loophole in the wash sale rule. Watch his interview at the end of the video. One of the ways one can cut their tax bill is by tax loss harvesting. When you sell an investment that is underperforming and losing money, you can use that loss to reduce your taxable capital gains and offset up to $3,000. But there are issues to consider before utilizing tax loss harvesting, and one of those issues to be aware of is the wash sale rule. Back in the day, if your investment is not performing well, and you are losing money, you could sell your equity and utilize the tax loss harvesting. Back then, investors would just buy the same equity at a lower price after selling, on top of tax loss harvesting. To avoid such actions, IRS proposed the wash sale rule. The intent of the wash sale rule is to prevent taxpayers from claiming artificial losses from the sale of securities, while essentially maintaining their position in the securities. If an investor sold losing positions of a company's shares, and buy back the same company shares within 30 days, then the loss from the selling of the shares would be disallowed for tax loss harvesting by the IRS. However, modern investing is very different than the old days. There are lots of index funds that track certain industry, even the whole market. With enough research, you can track some ETFs, where you may sell your losing shares, but buy shares from a different, but similar industry. Sometimes, the wash sale rule is avoided by selling a class of shares, and buying a different class of shares from the same company. All these are known information, but tracking them and properly utilizing them is difficult, and this is where the rich have an unfair advantage. Although the solution to this problem is not trivial, but if no changes are made, then a certain class of investors will always take advantage of these loopholes.
Here, he wrote that story for ProPublica and joins us on the set to explain it. So let's as they say, tell it to me like I'm 5 years old.
Sure.
What happened here?
Right. So I think the easiest way to think about it is to go back 100 years ago, where if your stock was down, you could simply sell the stock, take the tax loss, and then buy right back into the position. And you have your tax loss, you really haven't changed your investment. And it's sort of a strategy that went viral, particularly in 1920 when the market was down. And so Congress said, no, you can't do that. That's too easy to collect that loss. You know, flash forward to the present day, investing has obviously changed a lot since 1920. This is a law that actually had bite even going back to the 1990s. And essentially, the shift that happened and made it so basically it's toothless now, it's very easy to get around for anyone who's reasonably sophisticated, is, you know, investing has changed. There's a lot of passive investing. You can follow indexes and that sort of thing. And if you're tracking the S&P, there's a lot of ways to get basically the same exposure without necessarily getting the exact same position again. And that has led to all sorts of products springing up, particularly something called direct indexing, where basically you can own a pot of stocks, you can be tracking the S&P, and then, you know, asset managers, you know, Goldman Sachs we focus on in the piece, but Northern Trust, Iconic Capital is another place we focus on. They handle the Facebook guys, like Zuckerberg and Dustin Moskovitz in the piece. You know, they've set up these products that are just serving up tax losses essentially to their clients. And no one, this is not a secret. You know, this is like actually a pretty popular product. It's like in the hundreds of billions of dollars in terms of how many assets are in these products now.
So here's the question, though.
It tracks what you're selling. It tracks whatever it is, and then you.
Yeah. Well, so there's two issues here. One is with Steve Ballmer in particular. At least that was the example that you put forth. He was buying, for example, one class of shares of like Shell, for example, and then buying another class of share of Shell afterwards.
Yes.
So let's just start there, because that's the same company.
Right.
Is that illegal?
So the only thing that is very clearly illegal is same stock, same account. Right. That's basically what it is, and that's really all that's enforced. I think is one thing.
Okay. So from a tax, but then the question becomes from a tax policy perspective. From you know, if you're the government, you're the IRS.
Yeah.
Do we believe that Class A shares of one company are the same as Class B shares, and whether those should be allowed to be used in that kind of way. That's the most obvious version of this.
So when we noticed this, when I saw like, hey, Steve Ballmer's buying Shell, selling Shell, that seems like the same thing. They're not exactly the same QSIP because they're common shares, different classes. So we brought this to Goldman Sachs and said, hey, we're seeing hundreds of these types of trades because it's not just Shell. It was other companies that have 2 different classes. And they said, basically, whoops, we didn't mean to be doing that. I mean, this goes back 10 years. And so what they've told us is that they're notifying clients that we're unwinding these trades. We're not going to do these anymore. Steve Ballmer said he's going to amend his taxes.
But here's the more okay, so that's one version of it. The more complicated question is, let's say you're buying this basket that we think closely tracks another basket. But the baskets are fundamentally actually different stocks, right? So this one might have Microsoft in it. This one might have Alphabet in it. But if you mix those up with a couple other things, they historically have tracked each other relatively similarly.
Right.
Are they really different or not? And therefore, if you are sitting atop the IRS or sitting at Janet Yellen's position or somebody else,
it's going to be hard, though.
Should those positions be allowed to do what you're describing?
Basically, what tax experts said is like it's a perfect end run around the law as it is written right now. The law is essentially, if you're a sophisticated investor, it's very easy to get around. And so these products, if you pay attention to what you're doing, the only people who really run afoul of the wash sale rule are going to be retail investors who don't really know how to do it.
You could get 0.99 correlation on anything you sell, and it must be done all the time.
And these products say to like people like Steve Ballmer who are in like these direct indexing funds, hey, we track this perfectly, basically. You're going to be able to follow the S&P up while we spit out tax losses for you. So on paper, you're getting wealthier, but you get tax losses to offset other gains.
Is the point to